Good evening, everybody, and welcome to St Mary Le Bow. It's very good to see you here in such good numbers this evening. I'd also like to welcome on our collective behalf James Featherby and to thank James very much for agreeing to give this evening's JustShare lecture. Before I introduce James, I should just briefly explain a little bit about who I am. My name is Mark Ashworth. I'm a member of the congregation here and a trustee of Arcubus, the City of London Social Investment Fund for Microfinance in Africa, which was established by JustShare at St Mary Le Bow. And during the day I work at Law Debenture, and we are a professional trustee company, and my area of work is with pension schemes of British companies, both large and small. But more importantly, I'd like to introduce James, who may well be known to some or many of you. James has worked in the city for more than 30 years. For most of this time, he was a corporate finance partner at the eminent firm of Slaughter & May, specialising in cross-border mergers and acquisitions and also in real estate investment. But James is now personally and professionally involved in a number of investment activities in the UK and Africa, and has since the beginning of this year taken on the role as chair of the Church of England's Ethical Investment Advisory Group. James is also the author of a recently published substantial report entitled Of Markets and Men, Reshaping Finance for a New Season, which has been jointly published by the Institute of Chartered Accountants of England and Wales, the London Institute for Contemporary Christianity, of which he's a fellow, and also Tomorrow's Company. And this report, if I may say so, and if I might recommend it to you, is a powerful and compelling analysis of business and investment issues, and advocates what James calls, memorably, by-productive investment, by which he means investment which accepts a measure of responsibility for the well-being and positive development of the business activity in question, and which is then rewarded by what James memorably calls the paradox of profit. And having said that, I'm pleased to say that copies of that report are available for anybody interested afterwards at a discount, I think, of 40% on the published price. So that's, I think, a deserved plug. But now I would like to ask James to take the lectern, and I'm sure that we're all looking forward to hearing about what we might do, what might be done to change the city. Thank you very much indeed. And James, over to you.
I have to say it's slightly concerning being clapped before you've started, but there you go. Excellent to be here, and can I say a very big thank you to St Mary's and to JustShare for hosting this evening, and it's great to see a number of faces that I recognise and are smiling at me, so welcome to you. I hope you'll forgive the retired lawyer in me if I just mention that my comments this evening are personal. They don't necessarily represent the views of any of the organisations that I sometimes represent. There are three topics that I would like to cover this evening. First of all, I would like to describe the grid that I find helpful when I think about re-energising business, including in the city. Second, I'd like to mention just one response that we as savers and pensioners can make to hasten the kind of change that we would like to see. And third, I'd like to say something about where I think we now are on the journey of reform and what success might look like as we think about change. Reminding ourselves at fairly regular intervals that what we saw in 2008 and 2009 was a catastrophic failure of capitalism in the West. If the capitalist model of the late 20th century had been true to its real colours, virtually every Western bank would have collapsed. They would have taken with them probably every Western insurance company and pension scheme holding their bonds, and the reputations of nearly every asset manager and investment consultant would also have sunk beneath the waves. So I think we do need a step change if we are not to slowly creep back to what some call business as normal. I also want to emphasise at the beginning that I do love the city. I love the people who work here, and I'm passionate about seeing the city play its full and best role in the life of this country and further afield. The mess that it's got itself into and the stunted lives of the many who work here who've fallen prey to its many false promises, I find very distressing. Now, business and finance won't on their own solve all of the world's problems, but we will struggle to solve the world's problems without the help of business and without the help of the finance that supports it. So my intent this evening is not to tear down, it's to build up, even if that is after a bit of judicious pruning. Okay, so let me try and explain the grid that I'm personally finding helpful as I think about the process of reform, including in the city. The grid has 5 parts to it: purpose, structure, regulation, incentives, and culture. Holding this grid together is a belief in the vital role that institutions play in creating and maintaining our corporate life together. Whether those institutions are families, businesses, universities, local authorities, or if I may say so, even churches. I believe that God has given us institutions as a way of channeling our energies into beneficial outcomes. When they function well, they form habit patterns out of our good intentions. They encourage the good and they discourage the bad. Societies fail when they have institutions that extract rather than contribute. Societies can flourish when they have institutions that serve. But back to the grid. It's becoming increasingly clear, I think, that the question of purpose is absolutely vital. Where there is no vision, the people perish. This is true, I think, both at an industry level and at an individual business level. The city, you might think, has little purpose other than to connect savers and borrowers. Its purpose is to channel capital from savers to high-performing companies, and then to ensure that the profits of those companies or borrowers are translated back into returns for savers. And to perform that service well, the costs of intermediation by the financial services industry must be minimised, and players must be able to assess fundamental values. When this fundamental purpose is served well, then society benefits. Now, of course, an element of market making and liquidity are necessary to support these fundamental purposes, but it is clear to many, I think, that the market is now being used for many reasons that have very little indeed to do with this fundamental and beneficial public purpose. It is the responsibility, I think, of every financial services business to ask itself whether its operations are damaging the fundamental purpose of markets. Many may fail that test. The question of purpose is also fundamental, I think, at a more granular level. The paradox of profit is that profit comes after service. Look after your customers first, and then profit will follow. It's surprising, I think, how far this principle has been forgotten by some in the city. Many have business models that look inwards, seeing customers as little more than revenue streams. I think we need instead business models that look outwards, constructed with customer service as the central pillar around which everything else is built. Operations and products that serve the customer are allocated capital. Those that don't, however profitable they may seem in the short term, are closed down. Trust can only be restored by being worthy of trust. Customer service, looking out for the needs of the community and then setting out to meet them, I think is the only long-term sustainable business model. And I believe that it's only by rediscovering that public purpose that the city can find the direction, momentum, passion, and energy it now needs to find a new way forward. I'd also mention here, by the way, that ethics without purpose are pretty lifeless. In fact, ethics are stifling without purpose. Only purpose provides the necessary energy and courage to follow good ethics. Unilever, you know, has become one of the most admired companies in the world, and its purpose is clear. It's not to create shareholder value. It's to solve the health and nutritional problems of its current and potential customers. Here are some recent comments from Paul Polman, Unilever's chief executive. The very essence of capitalism is under threat, as business is now seen as a personal wealth accumulator. Winning alone is not enough. It's about winning with purpose. What I want is a sustainable and equitable capitalism. We are seeking to stay close to society to guarantee our future. This is, I think, why banks are now struggling. They are finding it difficult to express their purpose other than by reference to financial metrics that mainly serve themselves, their shareholders, and their executives. If they can't find and communicate a more inspirational public purpose, then their prospects may be limited. Okay, the second part of my grid is structure. Sometimes the structure of a market or an industry can make it nigh on impossible to have a positive purpose or a positive culture. And that is where, in some respects, I believe the City and Wall Street now stand. The problems arising from public subsidies for banks that are too big to fail, asymmetric information between traders and clients, multiple layers of agent-principal conflicts, oligopolistic markets, obscured fundamental values, and the dangerous funding embrace that exists between governments, central banks, and commercial banks are simply overwhelming many attempts to improve cultures and behaviours in the city. The obstacles to good behaviour are too many, and the temptations to poor behaviour are too frequent. The structure needs changing. One major structural issue that I believe we do need to address in particular is excessive debt. This is in part because of its effects on society. Excessive debt centralises power. It increases inequality. It encourages profligacy. It produces inflation. It creates unstable economies, and it traps the poor. And as we're now seeing right across Europe, it also undermines democracy. Governments and banks are the engines that manufacture debt. We need to put brakes on the system and slow them down. And we also need to unpick, it seems to me, the Faustian pact under which banks are underwriting government spending promises in return for central bank funding. Another major structural issue I need to address is speculative trading and what I call claims-based trades. That's basically hedging and derivatives. Their volume and velocity are economically damaging because they are damaging the efficient operation of the fundamental purpose of markets. There are the rents extracted by the sector, the instability they add to the system, and the distorting effect they have on fundamental values. I believe we need to draw some lines between hedging that covers genuine business risk in the real economy and hedging that is, frankly, just betting. Support the former and lean against the latter. Now, what about the third part of my grid, which I personally differentiate from structure? We do seem to have a fascination with regulation. Even those of us who read our Bibles and see God's failed attempts to deal with the ancient Israelites through the law still have a tendency to reach for the regulator every time a problem appears on the horizon. Regulation is a very poor way to improve behaviour. It's always costly, it's usually ineffective, and it's often counterproductive. I'm not sure why we're so attracted to it. Maybe it's because politicians who have so few other levers always want to appear in control. The fourth part of my grid is incentives. Now, by this I of course include pay, but I also mean much more. I mean social and intellectual motivation. One of the most pressing tasks for business leaders today and for politicians and academics is to explain why the common good is good for all of us. Because for the most part, we do the things that we think are good for us. Now, by talking here about the common good, I'm not, by the way, making the case for socialism over capitalism. I'm making the case for individual freedom within a communal context. Or to quote the African proverb, I am because you are. We urgently need to make the case for thinking that is relational, holistic, neighbourly, humble, adventurous and principled. It is that case, once made, that is the real incentive to behaviour that delivers the beneficial public purpose to which we aspire. Our finance today reflects our philosophy. The Enlightenment, despite its many benefits, has led us to think in a way that is individualistic, reductionist, utilitarian, pragmatic. Surprise, surprise, that's what our financial system looks like. Now, if we want to change finance, it seems to me our minds must be transformed. The financial crisis was and is a human, not a technical issue. Morality matters, but we have to be able to explain why. Morality has a great business case, so let's make it. We need relational thinking because it's relational thinking that leads us to act in a way that benefits customers. We need holistic analysis so that we can make the connections and have perspective and judgment. It's holistic analysis that shows us that there are such things as externalities. There are no such things as externalities, only feedback loops that have not yet fed back to me and my family. We need neighbourly analysis so that we can appreciate our own powerlessness and poverty without the welfare and contribution of others. It's neighbourly analysis that reveals the deep magic that comes from customer service and servant-hearted leadership, instead of relentless revenue harvesting and despotic business plans. We need humble thinking. It's humility that allows economists to welcome the contribution of anthropologists, that allows bankers to model risk based on biology as well as mathematics, and that allows leadership to value the contribution of spirituality. Without humility, we are too proud to listen, too arrogant for the unexpected, and too short-sighted to be flexible. In an accelerating universe, it's only humble analysis that makes us ready for change. We also need, I think, adventurous investment. Debt investments are anxious investments. They protect the lender against the uncertainties of the future. With scheduled repayments come hell or high water. It is no coincidence that debt has increased as trust has declined and society has become more fearful. What we need now is the optimism of equity investment, a collective investment approach that is hopeful and adventurous, an approach that is prepared to trust others and then support that investment with yet further political, cultural, technical, and relational support. Thinking. Evidence-based decision-making has its place, although I think we would all benefit from being a little bit more honest about the fallibility and bias that lies behind a great deal of so-called evidence. Evidence-based decision-making is a science invented by experts. It denies the power of the human mind to imagine out of nothing and then create. And there is no evidence when you find yourself in a novel situation. In a fresh landscape, only good principles can act as a reliable compass. So purpose, structure, regulation, and intellectual incentives. The fifth part of my grid is culture. Get the purpose, structure, and incentives right, including both pay and what I'm calling this kind of broader intellectual rationale for why doing the right thing is the best thing. And then culture change, it seems to me, becomes possible. But if your purpose is only financial, if the structure of your industry constantly puts you in conflict with the best interests of your customers, if you genuinely believe that you can flourish without reference to your effect on others, then no amount of ethics training or swearing allegiance to corporate mission statements will ever change your culture. Now, I'm conscious I've spoken little about personal integrity and character, topics we normally expect to discuss a good deal here in church. What has become clear to me over the last few years, though, is that personal integrity is not enough. Personal integrity is little more than polite manners when it's in a business with no public purpose, when it's in a structure that over the decades has come to work against the common good, and when it does that so convincingly well that even you are persuaded that black is white. It's not just that private integrity without public morality is a pretty limp affair. When a crowd's financially and intellectually incentivized to rush south, walking north simply gets you crushed. To turn the crowd around, you have to join with others and persuade them that the pot of gold at the end of the rainbow lies in another direction. So that was my suggested grid. How can we, as pensioners and savers, help to bring about the kind of change that we would like to see? One major issue for us to consider, I think, is the objective that we, as savers and pensioners, set for ourselves when we invest. The current mantra of investment, as you may know, is maximum return commensurate with risk. This is the mantra that most of us follow when we invest on the stock market, or at least it's the mantra that most of our pension managers follow on our behalf, perhaps without asking us. I believe that that mantra of maximum return commensurate with risk is an investment objective that is well past its sell-by date. I believe we need to apply in investment the same paradox of profit as applies in business. Business must first contribute towards customer need before it can expect to receive a profit. We also need to learn that in investment, sowing before reaping. Before looking for a financial return, we must seek to put our capital to productive use, investing in our capital into companies that are producing goods that are good and services that serve, as well as sound financial, environmental, and other social benefits. Not on the basis that these are somehow separate items, but on the basis that they are all interlinked, interdependent, and mutually supportive. This is what one might call bi-productive investment, investment that is productive at both ends of the investment chain. If maximum return commensurate with risk is the strategy pursued by all of us as savers, that will be the only message transmitted by the markets to companies. The result is inevitable sooner or later: scorched humanity, socially and possibly environmentally. If you want to change your investment strategy to buy productive investment, you'll need to talk to your pension fund manager or financial advisor. But be warned, expect some resistance. So in conclusion, where are we now? The Chief Rabbi, Lord Sachs, recently put it rather neatly. We are reaching the end game of a great experiment that didn't work: society's attempt to live without a shared moral code. Now, there are some voices in some companies outside the city that get it. And there are some very encouraging conversations going on in the city. But by and large, my feeling is that the city still does not get it. Or where it does get it, it feels it has very little room for manoeuvre. I believe it will take some bold political action to cut some deep-rooted and complex Gordian knots in the city. But it will also take some bold decisions by city business leaders to focus on beneficial public purpose as the only route to long-term sustainable success. So what will the successful financial services business look like that emerges out of this new landscape? They will be able to define and communicate clearly their beneficial public purpose, and they will have a business plan that is defined by that purpose. They will compete with their peers based on customer service and value for money. They won't seek to dominate an industry sector in order to control its revenues. They will think relationally, not transactionally. They will probably be small, but if they are big, they will have mastered the art of also being local. They will invest in understanding economic needs, both at a national and at a local level, and they will be assiduous about trying to meet those needs. They won't be afraid to experiment and sometimes fail in the quest to do that. Innovation will be customer-focused, not revenue-focused. They won't wait for Westminster to pass new laws before adopting their new business plans. They won't be the beneficiaries of public subsidies. They will remedy any injustice caused to one set of their customers by virtue of a cross-subsidy within the business given by them to another set of customers. They will take the lead in educating savers about the importance of integrating environmental, social and governance issues into investment decisions. And they will be deliberate about channeling savings towards borrowers and companies who themselves have a clear public purpose. They will redefine sustainability so that it doesn't mean living at the edge of the environmental envelope, and so that it includes helping individuals and communities to flourish, not survive. They will constantly ask themselves, should this be done? Not, can this be done? They will be guided by principles of fiduciary duty, not caveat emptor. They will acknowledge the inevitable externalities and injustices caused by any industry, and they will work hard to help the 20% minority who are never satisfied in customer feedback surveys. They won't support industry trade associations when they seek to protect vested interests. They will have staff who are not overworked and who have rich and varied family and community lives, and by the way, as a result, have better commercial judgment. They will have staff who are proud to work where they work, inspired by their contribution to society and a good salary, not by utilitarian bonus targets. They will seek to minimise costs, not to boost shareholder and executive returns, but to increase the returns they can offer to savers. They will promote based on character as well as competence, and they will have leaders who are open and servant-hearted. They will lead through team, not through ego. They will largely ignore the voice of short-term share traders. They will build loyal shareholders attracted by the more stable and sustainable profits that their new business model will produce. But we do need to be realistic. Not all of the city will change. But maybe first mover advantage will go to those businesses that first understand and pursue their public purpose. If not enough businesses change, then trust in the city will continue to evaporate. Young talent will increasingly seek its future elsewhere, and the square mile's global influence will slowly fade away. Investors will not invest in a system they don't trust, because you may be able to fool some of the people some of the time, but you can't fool all of the people all of the time. But if the structural obstacles to helpful behaviour can be removed, and if enough businesses in the city can decide to serve the real economy, then maybe once again its word will be its bond, and it will continue to serve the best interests of this country and many other countries as well. Thank you very much indeed for being such a patient audience.
And thank you very much indeed, James, for a fascinating and very thought-provoking analysis and set of challenges and suggestions. I'm pleased to say that we now have time, and James will be delighted to take questions. What I'd like to suggest is that if people would like to introduce themselves very briefly and then ask a question, then I'm sure we can continue and develop that discussion we've just started. Who would like to start with a question?
Hello, my name's Christine Allen and I work for Christian Aid. Probably doesn't need any explanation. James, thank you for that. I think from Christian Aid's perspective, we're very keen, and we know there's a really strong kind of moral and sort of ethical arguments behind what you're saying. Can you explore a little bit about how people like us how we can talk more about what are the commercial advantages to the kind of public good that you've just talked about, and perhaps talking about some of the experience around like the Aviva investors, people like that, about how we make more explicit that there's a business case behind this agenda, not just a kind of wimpy, ethical, idealistic kind of, oh, we should have a better world, shouldn't we, kind of case.
Yep.
Does that make sense?
Yep.
So how do we advocate the paradox of profit?
Yep. I think often stories are the kind of best example, and I don't know if your customers are QuickFit, but my observation is that by going to QuickFit, I get a fantastic service by a pleasant young man who gives me the tyre that I need. He smiles at me, and I feel I want to go back. That, to me, is good ethics and good business. And I think we all have experiences of situations in which we know that customer service is what produces long-term recurring revenue. And that is what business is supposed to be about. And as investors, that's what we should be looking for. So I think we can find stories on a small level. But, I mean, as I said at the beginning, let's not forget what happened in 2008 and 2009 and why it happened. And obviously there are lots of reasons as to why the financial crisis happened. But one strong reason, amongst others, is a financial system that put short-term returns above long-term financiability and financial returns. There are many, many, many examples of that, but one simple example is banks making 20-year loans on properties where most of the fees were up front and were received by the bank, brackets, and its executives, close brackets, up front. That kind of model, it seems to me, we have more than amply demonstrated leads to collapse.
Thank you. Gentleman there.
I'm Matthew Butcher from Fair Pensions. A lot of what you were saying actually really ties into the work that we do at Fair Pensions, and I was particularly struck by one of the things you said, which was that one of your recommendations was that people get in touch with their fund managers or their pension provider, and you said they might say something to put you off. And that's actually an experience that we've seen really regularly. So one of the things that we do is we give people the chance through our website to contact their pension fund, which I think is the only way that people can really do it directly. So most pension funds are listed on our website. People can contact them. But you're right that there's a big challenge there because, there is this asymmetry of information. So your average person who has a pension fund doesn't really understand the law surrounding that. So we've had a number of examples of, well, first of all, it's important to say that there are some pension funds who respond very positively and are really conscientious about explaining things. But we also have a lot of people who contact their pension funds and sort of bounced away with jargon, often fiduciary duty. So they might want their pension fund to act more responsibly, and they're told, well, sorry, but our duty to you is to maximise short-term profits, and that's our only duty to you. And of course, when most people, including myself about a year and a half ago, have the words fiduciary duty thrown at them, they automatically seize up and don't really want to go any further down that road. And one of the things we've been looking at is actually exploring whether or not fiduciary duty has in some ways been misinterpreted over time. And I'm sure you're aware of the K review. The K review came out, and that's something that he's said that he will look at. He's actually referred that specific part to the Law Commission. And so I really wanted to just say that, two questions really. How do we help support ordinary people who don't understand a lot of the complexities around this to not just be put off by terms like fiduciary duty? That's the first question. I guess the second question is, do you think it's important to have a re-clarification really of fiduciary duty?
Thank you very much, Matthew. So how do we empower the beneficiary who may not understand the worlds of finance and the words of finance? And do we really need to clarify the law, or is the law clear enough, but just people haven't actually taken the discretion that's already there? James?
I think it would be really helpful if the law was clarified, changed. I think I can build, as I'm sure you, a very strong intellectual case as to why taking ESG, as it's called, environmental, social and governance issues into account actually should form part of somebody's financial duty. But for some reason, some people are not convinced. So a change in the law to clarify that seems to me to be extremely helpful. I would say that some of us, though, are not in pension schemes that have those kind of issues. We might be in a SIP, or we might just be investing ourselves. And in that instance, nothing stops you going to your asset manager and saying, I don't really care whether you think it makes a difference. I'm convinced it does, and that's what I'm asking you to do. You will find that some are receptive to that message, but others may not be. Look around and find another one.
Thank you. Gentleman there. Yes, please.
Yes?
There's a microphone coming to you, sir.
Will this help?
Yep.
Okay. How do I do it? All right. I was in the city for quite a long time as a merchant banker. And it seems to me that since Big Bang, there has not really been a recognized ethical standard of doing business in the city. And there is a sort of Gresham's law, which the bad behavior drives out the good behavior. Now, you are a lawyer, and there's one specific point which I think one could examine quite carefully. You mentioned caveat emptor, and the question is it ever going to be possible to shift that thing out of the English legal system?
So beware the buyer.
Yep.
Can we avoid that?
I don't think we will get it out of the legal system because actually it's quite a useful principle for buying second-hand cars. But I think financial services are different because the difference in power and information between buyers and sellers is so strong. And I don't know if you've been following Professor John Kay, but he wrote a report fairly recently for the government on short-termism in the markets. And one of his key ideas, which I would wholeheartedly support, is to make fiduciary duty like a golden thread that runs right through the whole financial services asset management industry. I think that's an extremely powerful idea. It would get away from caveat emptor, and I think would really make a very, very powerful change.
Thank you. Now we've gentleman there. Thank you.
Hello, yeah, Daniel Brooksbank from Responsible Investor. Not really a question, just some sort of observations, really. When I first came into investment, you had the prudent person principle, or the prudent man principle. We don't really hear about that anymore. That seems to have been, haven't really heard anyone talk about that for a long time. Surely we need to apply that, or think about that, or fold that into some of this discussion here. And the other thing that strikes me, when I started at Bloomberg, one of the words, we had banned phrases we couldn't use. One of them was market correction, the idea that markets are always right, so how can they correct? So it's this idea that capital always, like water, always finds its own level. I mean, how does that fold into this, where capital will always go where it gets a return? How do you sort of square that with some of what you're talking about here, where capital is almost like a force of nature? Is that just really an observation, really? Thanks.
So are the currents in the markets too strong for us to influence or not?
Again, that's an issue that Professor Kay addresses quite well. And again, I think people are now recognizing that the market is not always right. In fact, is quite often wrong. Depends what you mean a little bit by right and wrong, but it tends to measure things on a very immediate mark-to-market basis. And if your investment horizon is 7 years, not 7 months or 7 days, you end up with different ideas as to what value really is. So, I mean, I think I'm just agreeing with you, really.
Into something that we can really use when capital is doing this. How do we implement it? When the markets are doing this, it's such a huge multi-billion, trillion-dollar market. How do you actually change it from doing that?
I think there are two things one can do. One is I think we need to build for ourselves a much more sophisticated understanding of where long-term value comes from. And there are lots of people doing a lot of work on that. And clearly looking at financial statistics on balance sheets and P&L accounts doesn't really tell you a great deal about the future ability of a business to generate repeating returns. So there's a whole host of other things to look at to try and spot where long-term value comes from. The other thing, of course, we can do with the market is to choose to ignore it and to have our own view. And that was, very much the Warren Buffett view, is basically the market is always wrong. And what do I think?
Thank you. Another question, gentleman there.
Hi, I'm Richard from the Fair Trade Foundation. I was at a conference a few weeks ago in the food and drink sector, and people were talking about Paul Polman there and saying what leadership he was showing within kind of food and drinks industry. And then someone raised a very good point around, actually, he's 30 years behind pioneers like Anita Roddick from The Body Shop. But even he's struggling with the city to justify that long-term investment proposition. He's having to report to shareholders about a very short-term turnaround where he's trying to deliver long-term sustainable growth. And my question is the same leadership that Anita Roddick showed 30 years ago and Paul Polman maybe is showing now in the city? Because if there isn't leadership in the city around ethics and sustainability, and that needs to be from an individual in many cases, then actually Paul Polman can't do what he wants to do in Unilever, and we can't invest in ethical investment propositions anyway. So I don't know if that kind of iconic leadership exists in the city, and what's preventing a big business or a big city leader following where we see elsewhere. It just seems absent in this particular sector.
Well, thank you. Are there leaders, and maybe if there aren't, how do we encourage people to emerge, to take on that leadership and take up that example that you refer to?
I have no idea how secure Paul Polman's position is. He seems pretty secure to me. And I think one of the marks of a great leader is to build a team internally to come on after, and I assume that that is what he's doing. He speaks very publicly about not being interested in his shareholders. He does that provocatively. The point he's trying to make is that he has a clear view of how to build long-term sustainable success for Unilever. And his view is that it is only by identifying and then solving health problems in communities that Unilever has a long-term future. And I think he's provocatively saying to shareholders, I'm not interested in you, because he's trying to say, I only want the shareholders who also think that that is the only way to create long-term value. He's in the fortunate position, I think, of being able to say that, because actually, like many companies at the moment, they are not raising equity from shareholders. Most of the trading that happens in the city is not providing capital to companies. Most of the trading is kind of you and me selling shares backwards and forwards between us. Very little of the activity is providing capital to Unilever. So, in a sense, he like many, many other businesses at the moment, with the possible exception of banks, are able to say, actually, we're not really interested in shareholders, we don't need them. I don't mind whether my share price is 100p or 200p. Doesn't make any difference whatsoever to how the business operates, how successful it is, and what kind of returns we give to shareholders. Are there others like him? I hope and pray that there are. And that's why I think it's really important that we as society, including us as savers and pensioners, start saying to the city stroke the market, we're thinking differently. Would you please do what we're asking you to do, because it's our money.
Thank you. I think we've got time for just a couple more questions. Lady here.
Hi, my name's Sian from Comic Relief. My question is, if I understood correctly, you were saying that your vision for the banks of the future, or the financial institutions of the future, would be that they would be smaller. And I was curious if you could see a time when peer-to-peer lending schemes would become the norm, so Funding Circle or these types of schemes that are now being driven as a result very much of the internet, and perhaps some caution about giving your money to more conventional financial institutions.
Thank you. It's a really interesting question. So the implications and maybe application of the internet and peer-to-peer lending as a way of enabling individuals to be directly connected with business. James, your thoughts about that? How can that be mobilized for good and for change?
I think some of those moves, like peer-to-peer lending, which in a sense is a kind of small-scale thing, but actually on a large-scale example of that would be, let's go back to Unilever. Say Unilever needs $1 billion. Where does it get it from? Does it go to Barclays? Usually, actually, these days, no, it doesn't. It goes straight to the bond markets. So banks are beginning to be bypassed. What are most banks interested in? They're not that interested in lending small amounts of money to you and me or to our local corner shop. They are interested in lending money to large public companies. And I think one of the crying shames at the moment is kind of the withdrawal of the local bank manager, because who else has the passion, the energy, and the know-how to provide funding for SMEs? So it seems to me that we are at the beginning of a little bit of a tussle over how banks operate and what their kind of customer base and purpose is. I personally think the only way banks have a long-term future is to go back to their local communities and find businesses that need capital and provide it to them. But we will see.
Thank you. Maybe the final question, gentleman there, sir.
I'm very interested in what you say about quite a few big companies that are not very interested in the shareholders. But when you went on to say they didn't care whether the share price was up or down, well, I think they normally would, because that is what interests shareholders most, really, the performance of the company reflected in the share price. But what I wanted to say was that the small shareholder, those people who consulted Fred at the time of the gas privatization and so on, they've disappeared almost out of sight because they're all held in nominee accounts and they own trusts, they have shares in trusts, and therefore their voting power, maybe their commenting power is there for an AGM, but their voting power has really disappeared. So now you have the big institutions with the power, broadly, and of course you have the non-executive directors on the boards, but the non-executive directors often are under the thumb of very strong chief executives. So you haven't got much countervailing power available to counterbalance excess.
James, how do we put the individual back? How do we address that imbalance of power and information?
I think it's tempting for us as consumers, effectively, to think that we can change the world, and it would be nice if we could, but I'm not sure we can. There are things we can do, and some of those things I've been talking about tonight, about talking to your IFA and asking him to invest with a slightly different objective. But I think the real change won't come until the boards of big companies decide what their business plan is going to be in the new landscape. There are things we can do as shareholders, whether individual or institutional, to support that. But the best change normally comes when people decide for themselves that change is a good idea. We're not there yet, but some people are beginning to get there, I think.
Thank you. Well, there were some other hands that I'm afraid I didn't have an opportunity to call upon in this formal session of question and answer, but I am pleased and would very much welcome. I know James is happy to continue for informal questions and answers in just a moment. But before we do move to that, could I, on everybody's behalf here, express sincere thanks for the time, the thought, the experience, the skill, the care that you've brought to and shared with us in setting out a framework that I think helps make sense of what, to many of us, seems to be a bewilderingly overcomplicated concept and set of issues. I think you've helped give us an intellectual structure that we can hang and relate our thinking on. So that's been a privilege and a real benefit to us. I think it is also encouraging that we have such a good number here on a fairly dark October evening who've come together to think about and to discuss what might be done. One of the advantages I think that we have seen following the traumatic events of the crash is a general realization that actually we are and have been heading in the wrong direction, and that something more than tinkering needs to be done to get us back into the right direction and onto the right path. And I think your prescription of suggesting that we rediscover service and we rediscover the fundamental purpose and then wait for the profit to emerge is inspiring, it's clear, it's cogent, and something that we can take with us into our work and into our life outside this church. So on everybody's behalf, I would like to thank James very much indeed. I'd like to suggest that we express our thanks for what we've just heard and the discussion that we've just had. Thank you very much.